In this second video on capital budgeting, we're going to talk about some of the more peculiar aspects, if you will, of capital budgeting. We'll also take a look at another technique that's frequently used in concluding our discussions. So the first thing we like to do is talk about something called economic value added. Now this is a relatively new concept. And new in terms of finance is that it's really been around for maybe about 20 years. And finally, it's starting to find its way into textbooks as more and more companies start to use it. And essentially, economic value added looks an awful lot about like net present value. It certainly approaches or takes a similar approach. However, the difference is from those cash flows, the present value of the cash flows, ultimately we're going to look at the costs of financing. So the EVA calculation asks if a project generates positive cash flows above and beyond what investors demand. So it is a similar concept to net present value being cost-benefit analysis, but it does take a different approach to it. And in the end, what we're sort of trying to calculate, if you will, is we're trying to calculate this thing called pure economic profit. This is the profits that the company would recognize above and beyond the nominal competitive rate of return for a line of business. So if a project costs $1 million, but after that, it's going to generate some net cash flows each year into perpetuity of $120,000, right? What ultimately is the value to the company? Now, the numbers that we use, this $120,000 is that cash flow to perpetuity. The 10% here represents the cost of capital. And although we haven't talked about this a lot, this is actually the connection to the returns of owners. The cost of capital equals the rate of returns that the investors want to receive. So this does incorporate what investors want. And in this case, we ultimately have a net present value here of $200,000. So to calculate the EVA, right, we're going to start with that $120,000 cash flow, and now we're going to subtract out the cost of capital for the invested project. So again, if you subtract out $1 million times that 10% cost of capital, the economic value added for this company is $20,000. So both projects are, for the most part, probably always going to give us very similar answers, as in to do a project or not to do a project. However, in the end, this EVA really takes into account a more theoretical kind of a solution to this. And it tends to, investors or managers, tend to really kind of hone in on this concept of economic profit, and they sort of gravitate towards that particular topic, if you will. Another way to analyze projects is through something called the internal rate of return. Essentially, this is the rate of return that you earn if you buy the project and you actually receive the given cash flows. So it is the expected return you get from this investment. And if your expected return is greater than or equal to your required return, you would want to buy the asset. Now, for corporate projects, the required return for the corporate projects is the financing cost of the project itself. That's what we refer to as weighted average cost of capital, WACC. So if the internal rate of return greater than the cost of capital, you would want to buy the project. This is just our old investment rule that we've talked about through several videos. Now, it does talk about, in general, the textbook has a definition. It's the discount rate that equates the net present value to zero. This actually says this is the rate of return that it takes to get the present value of the cash inflows to represent the initial investment. Essentially, it's solving for return. So when we look at our two projects, we see that project A has an internal rate of return of 19.8 and B is 21.6. So again, if we want to do both projects, or if we can do both, we would like to do them both. Their internal rate of return is greater than 10%. But if we needed to do one, project B gives us a higher rate of return. And this is what sort of leads us into a complicating issue with respect to capital budgeting, right? Project A provides the greatest amount of value to the company, but project B provides the greatest rate of return. The answers don't agree with each other. There is a conflict. So in the next several slides, we want to talk about this conflict and why there's such a challenge. So again, the reasons for these conflicts is the ranking process. They are different techniques. So since they use different approaches, their answers will be different. Now, what you might note, if you think back to that slide, is both of these are good projects. The thing that's in question is the ranking, right? Which ranking mechanism should be best? We have a couple of things to show and talk about here, one of which is called a net present value profile. Essentially, it looks at a project's net present values at various costs of capital or discount rates. So we want to take a look at the two projects that we have. And in the capital budgeting techniques worksheet, this graph is presented as part of the worksheet. So sometimes you may have to adjust a little bit. You may have to start the return a little bit different. There's also a cell here that represents the incremental change, right? So again, we have here this incremental change as we go through here. It's going by 2% here as you see we go up the list here. So what we can see here is project A, right? Project A is the red line, project B is the blue line. And the line represents net present value at a certain discount rate. And what you can see is there's sometimes when A is better than B, and then there's times when B is better than A. This is the conflict that we're talking about. It would be better if we could have a technique that would always give us the exact same answer all the time. However, that's just not reasonable when you think about doing approaching questions from different perspectives. So why is there a difference? One of the underlying differences is something called the reinvestment assumption. Right? Think about this company. This company is going to get cash flows in the future. What will they do with those cash flows? They're going to reinvest them at an interest rate that's available when they receive them. So we know that in the future, interest rates are certainly going to change, and that's not really the issue. The issue is the mathematics of these two techniques. The net present value technique takes whatever cost of capital is present when money is invested, but the internal rate of return technique assumes that whatever this number is, that's the number that's going to be earned on average per year. So that is the interest rate that's going to be reinvested at. And that, especially for very profitable projects, that might be unreasonable. So again, net present value assumes we reinvest at the cost of capital. The internal rate of return assumes that we reinvest at whatever the internal rate of return is. Other issues have to do with timing, right? Where cash flows occur in the timeline is going to have an impact on net present value, right? So when much of the project's cash flows arrive early, net present value won't be particularly sensitive to the discount rate. But if the cash flows are on the other end of the timeline, the discount rate can have much greater impact. So the differences in timing, right, will affect net present value, but it will not affect the internal rate of return. Now the magnitude also will have an impact. In this case, internal rate of returns, again, may rank projects differently. The internal rate of return approach might favor small projects with higher returns. The net present value approach makes the favors the investment that makes the investor the most money. So again, the approach with magnitude and the underlying concepts of capital budgeting, the mathematics, all of these complicating issues will create times where there is a conflict. So which approach is best? On a purely theoretical basis, net present value is better. Why? Primarily because it measures the change in wealth, right? And that is the underlying fundamental concept that we've been talking about decision making. You never want to do anything that in the end would decrease the value of the company. In addition, there are certain mathematical properties that we talked about with respect to internal rate of return that may also create a disadvantage to using the internal rate of return. Now, despite its theoretical superiority, financial managers have a tendency to prefer the internal rate of return. Most of this is just because of their preference for rates of returns. They prefer the percentage answer to the dollar answer. And as long as we understand what we're talking about, and as long as they're very similar types of magnitudes, then there shouldn't be a real big issue. However, the bigger the difference between the projects, the more likely internal rate of return may give us an answer that's a little bit, might not necessarily maximize wealth. So what do companies actually do? There was some research done. The most popular approaches by far were the internal rate of return and net present value. About 3/4 of all CEOs use those techniques. But those also have wider use for the payback period, right, in smaller companies. So really, kind of depending on the size of the company, the sophistication of the managers, will determine which of these techniques is ultimately used. So that's the end of the videos on capital budgeting.